Imagine a business making roughly $66 million a year in pure verifiable profit.
Right, a massive amount of cash flow.
Exactly, but the people holding its stock get absolute zero of it. Like nothing.
Not a single cent.
The cash is just piling up in this locked corporate vault, and the shareholders are basically just standing outside looking through the window.
Yeah, it's wild.
And that is the exact reality of the Ondo token right now. Today is Friday, August 28, 2026, and we are diving into what might be the ultimate crypto paradox.
It really is one of the most fascinating structural anomalies in the market today, because you have a protocol that is wildly successful on basically every fundamental metric, but it's paired with a token that is absolutely cratered.
Exactly. I mean, the token is down over 90% from its cycle high.
Yeah.
So for those of you asking us to look into the Ondo crypto price prediction for September 2026, explain the mechanics behind it, and figure out where the bottom is, well, that is our singular mission for this deep dive.
And we are pulling from a massive stack of sources for this one.
We really are. We've got institutional research reports, market insights from KuCoin, on-chain data from Defilama, and official Ondo Finance documentation.
Plus some really detailed technical analysis from Binance Square analysts. People like Crypto Patel, Flipix, and Finora AI.
Right. And as we go through all these sources, there's really one central question we need to answer for you, the listener.
Which is basically, is the Ondo token a brilliant Wall Street Trojan horse that's just, waiting to unleash massive value? Or is it a structural retail trap?
Because honestly, depending on how a few key events play out next month, it could be either.
It really could.
Okay, so let's unpack this. Because to understand the charts for September, we have to first look at the massive disconnect between Ondo, the company, and Ondo, the token.
Right, the fundamentals versus the asset.
Yeah. In the real-world asset space, or RWA Ondo Finance is the undisputed king right now. I mean, they are tokenizing U.S. Treasuries, they are tokenizing public equities and ETFs with their Ondo stocks product.
They are sitting on a staggering $3.5 billion in total value locked.
$3.5 billion.
Yeah. And we need to emphasize that this TVL isn't just speculative crypto money, bouncing between liquidity pools.
Right. This is real institutional capital.
Exactly. Ondo has products like OUSG, which is heavily backed by BlackRock's BUIDL fund, and USDY, which offers yield to non-US retail investors. They are successfully bridging traditional finance and decentralized finance.
And they are doing it incredibly efficiently.
And profitably.
Yes, very profitably. Our sources estimate the protocol generates anywhere between $47 million and $66 million annually in real management fees.
But here is where it gets really interesting.
And frankly, a bit infuriating if you're a retail investor. Defilama data confirms that the revenue flowing to Ondo token holders is exactly zero.
Right, zero.
All of those millions in fees just flow directly into corporate entities, places like Ondo Finance Inc., USDY LLC, and the Ondo Foundation.
Which, to be fair, is a very deliberate legal architecture.
Sure.
They are using those funds to cover audits, operational costs, and obviously highly specialized legal teams.
Right. But meanwhile, holding the Ondo token only gives you governance rights.
Exactly. You get a vote in the Ondo DAO to manage parameters for Flux Finance, which is their decentralized lending protocol. But that's it.
No staking rewards, no dividends.
No programmatic buy and burns either.
See, I'm really struggling to understand the investor psychology here. Buying the Ondo token right now is essentially like buying a ticket to a massive blockbuster movie, right?
Right, I see where you're going with this.
But the ticket only gives you the right to vote on, the color of the theater seats.
Right.
You don't get a share of the actual box office profits. So if the Defilama data explicitly says token holders get zero revenue, why on earth is anyone buying this token today? Are they just gambling?
Well, they aren't gambling. They are actually anticipating a structural shift. You have to remember the reason this architecture exists in the first place is the regulatory moat.
The SEC, basically.
Exactly. Tokenized treasuries and securities live inside heavily regulated wrappers. Wall Street institutions cannot interact with anything that isn't strictly KYC and AML compliant.
Right. Know your customer and anti-money laundering laws.
Right. So by insulating the token from the cash flow, Ondo deliberately prevented the token from being immediately classified by the SEC as an unregistered security.
Oh, interesting.
Yeah, they built a massive moat by doing everything by the book, using registered broker-dealers, getting SEC transfer agent licenses, and gating products to qualified purchasers.
Which brings up those licenses, because a lot of people hear registered broker-dealer and just think, oh, it's extra paperwork. But why does that specifically form a moat? in the crypto space?
Because a registered broker-dealer and an SEC transfer agent are legally required to maintain what's called the golden record.
Which means they have to know exactly who owns what?
Precisely. In traditional crypto, a permissionless token, it can be sent to anyone, anywhere, completely anonymously. If Ondo's revenue flowed to a permissionless token, the SEC would lose that verifiable paper trail of ownership. And if that happens, their entire institutional partnership with entities like BlackRock would evaporate overnight.
Oh, so the token had to be structurally useless to protect the protocol's institutional growth.
Exactly. For now, at least.
Right. You mentioned earlier that investors are anticipating a shift. And that brings us to the single biggest catalyst hanging over this asset right now. The Ondo DAO is expected to vote on a fee switch in the second half of 2026.
This is the event. If you are holding Ondo right now, you are essentially holding a proxy bet on this specific vote.
Because if the fee switch passes, a portion of that $66 million in protocol revenue would finally begin flowing to the token holders.
Right. It acts like a regulatory pressure valve. The protocol has been building up all this revenue pressure, and the fee switch is the mechanism to finally release it to the token holders.
Either through direct yield sharing or maybe some programmatic mechanism where the protocol buys Ondo off the open market and burns it to reduce supply.
Precisely. And KuCoin's latest market insight points out that the passage of the Clarity Act in the U.S. Senate is the macro catalyst making this possible.
Okay, let's talk about the Clarity Act.
Yeah, fundamentally, it aims to create a safe harbor. It establishes a regulatory framework where if a network reaches a certain threshold of decentralization, its native token is no longer presumed to be a security.
Even if it has a revenue sharing mechanism.
Exactly.
But wait, let me push back on this timeline a bit. The Clarity Act is still pending in the Senate. We all know how slow Washington moves.
Oh, incredibly slow.
So if the SEC hasn't fully cleared this, aren't they risking those pristine institutional partnerships by even discussing turning on a revenue share right now? Like if I'm Franklin Templeton, I don't want my partner experimenting with regulatory gray areas.
And that is the exact tension keeping the price suppressed. It's why the chart looks the way it does. You are completely right. Wall Street values compliance and predictability above literally everything else. Turning on the fee switch without bulletproof legal cover is a massive risk. They need the legal shield of something like the Clarity Act to protect those institutional bridges while finally rewarding the retail token holders. It is a very, very delicate dance.
And dancing on a tightrope like that requires incredibly stable leadership. But even if they navigate the SEC and they manage to flip that fee switch, they still need someone legally authorized to sign the paperwork.
Yes, they do.
And right now, as we look towards September, our sources highlight that it's not entirely clear who that is, because Ondo is in the middle of a massive boardroom brawl.
Yeah. The corporate drama here introduces a level of fundamental uncertainty that technical analysis simply cannot quantify. In May of 2026, Nathan Ullman, the founder and CEO of Ondo Finance, tragically passed away.
At just 32 years old.
Just 32.
It's an awful situation. And what followed has turned into a deeply messy legal battle. After his death, former President Ian DeBerr took over as CEO. But Nathan's mother, Kathleen Ullman, who the community knows as Mama Ondo, is currently suing DeBode in the Delaware Chancery Court on behalf of the estate.
And to understand the severity of this, we really have to look at how a probate vacancy actually works under Delaware corporate law.
Okay, walk us through it.
When a founder with majority control passes away, their shares and voting rights don't just magically transfer, they go into an estate.
Right.
If there isn't a clearly established immediate executor, those voting rights are temporarily paralyzed.
And the estate is alleging that DeBud took advantage of that exact paralysis. They claim he seized control during this probate vacancy by essentially declaring himself CEO under company bylaws and then used a specific shareholder agreement to appoint himself as the sole director.
Yes, and the estate argues that filling a CEO vacancy requires a formal board vote, which they claim never legally happened.
Which brings us back to that counterparty risk with Wall Street. The Delaware Chancery Court is obviously the premier venue for corporate disputes because it moves fast. But while this lawsuit is pending, it introduces massive governance uncertainty.
Oh, absolutely. Think about it. If you are BlackRock and you are integrating multi-million-dollar treasury products, you need absolute certainty that the person signing the contract has the legally recognized authority to bind the corporation.
Right. If there is even a fraction of a percent chance that a judge in Delaware could retroactively invalidate a contract because the CEO wasn't legally the CEO, Wall Street compliance officers will just hit the pause button.
They will freeze everything. And if counterparties pause new integrations until the legal dust settles, that stalls the protocol's growth engine, just as they need it most to justify this massive total value locked.
And that operational stalling is happening at the exact moment the token is facing structural inflation. Which brings us to the tokenomics.
Yeah, we have to talk about the dilution.
Because it is relentless. On the 18th of every single month, scheduled token unlocks hit the market. For late 2026, this means 41.7 million Ondo tokens from the Series A round and 12.5 million from the C round are released into the circulating supply.
Which translates to roughly $20 million in structural supply pressure hitting the market around the 18th of every month.
$20 million every month.
Every single month. But it's vital to understand the mechanics of how this actually suppresses the price. It's not just that more tokens exist.
Right, it's the market psychology and the physical selling. How does that $20 million actually impact the order book?
So think about the venture capitalists and the early seed investors receiving these tokens. They bought in years ago at fractions of a penny. Even with the token down 90% from its high, they are still in massive, massive profit.
Right, they're still up hugely.
Exactly. So when their tokens unlock on the 18th, they often use over-the-counter, or OTC, desks to liquidate large positions without causing immediate...
But those OTC desks eventually have to offload that risk onto the open market, right?
They always do. Plus, you have algorithmic trading bots and retail traders front-running the event.
Of course.
If you know $20 million of sell pressure is coming on the 18th, human traders and market-making algorithms will start shorting the perpetual futures markets on the 15th or 16th. Every single month, the market has to absorb tens of millions of dollars of new supply and shorting pressure just to keep the price flat.
Wow. And September is just another link in that chain. But the real psychological weight is what's looming in the distance, because there's a massive cliff approaching in January 2027.
Oh yeah, the big one.
Where 1.94 billion tokens will unlock. That is nearly a fifth of the total maximum supply hitting the market in a single day.
It's a staggering amount of inflation.
So if you are a retail investor looking at September, you are staring down a legal battle in Delaware, the uncertainty of a pending fee switch, and the absolute guarantee of millions of new tokens flooding the market.
It sounds incredibly bleak when you put it like that.
It really does. But what do the actual charts predict for Ondo's price next month? Are the technical analysts seeing something the fundamentals are missing?
Well, technical analysis is essentially the visualization of all this fundamental fear and greed, right? Currently, Ondo is consolidating in a narrow wedge formation, trading roughly between 31 cents and 38 cents.
Okay.
This is basically the aftermath of that brutal distribution phase where it dropped from $2.15 down to a capitulation low of 20 cents earlier this year.
So looking at September, the price is basically a coiled spring trapped in a narrowing wedge.
Yeah, that's a good way to put it.
It's getting squeezed from the top by the heavy weight of those monthly VC token unlocks and pushed up from the bottom by speculative investors trying to front-run the massive fee switch vote.
Exactly. And depending on which analyst you follow, that spring is going to snap in very different directions.
Let's start with the bear case.
Okay, the bear case is heavily mapped out by Finora AI on Binance Square.
All right, Finora AI notes that short-term momentum is decisively bearish, pointing specifically to the fact that the price was recently rejected by the 100-period simple moving average at roughly 38.6 cents.
Yes.
But for our listeners who aren't day traders, why does that specific moving average matter so much?
A 100-period simple moving average isn't just an arbitrary line on a chart. It is the psychological baseline for medium-term trend followers.
Okay.
More importantly, it is a key trigger for algorithmic trading bots. When the price attempts to break above that line and fails, which is exactly what Finora AI observed, it signals to these algorithms that buyers lacks the conviction to sustain a rally.
And then the bots take over.
The bots then automatically start placing short orders, which creates a self-fulfilling downward spiral.
So according to Finora AI, if the buyers cannot defend the immediate support level at 31 to 32 cents, the entire chart structure breaks down. In that scenario, they expect the price to fall into the lower demand zone of 28 to 29 cents. If the weight of the September 18th token unlocks hits, and there is no positive news on the fee switch or the lawsuit, that downward path becomes the path of least resistance.
But there is a flip side to this coin.
The bulls.
The bulls. Analysts like Crypto Patel and Flippix are looking at this exact same wedge and seeing a massive asymmetric opportunity.
They point out that the token has successfully defended its deep accumulation zone, right, which sits between 19 and 25 cents.
Exactly. It bounced hard off that bottom and is now compressing between two major macro trend lines.
But what is the specific trigger they are watching for September?
So Crypto Patel is looking for a very specific confirmation signal. To confirm a macro bullish breakout and officially invalidate the downward trend, Ondo needs to secure a 3-day candle close above the 53.94 cent resistance line.
Wait, why that specific number, 53.94 cents?
Because that level represents the breakdown point of the previous market structure. It's basically the technical ceiling of the current accumulation phase.
Oh, I see.
If buyers can force the price above that level and hold it there for 3 days, it proves that the smart money has absorbed all the VC selling pressure and is aggressively positioning for the fee switch. It is the definitive line in the sand for the bulls.
And if it does break out, Flippix targets a relatively conservative 90 cents as the first major stop.
Right, but Crypto Patel maps a much more aggressive multi-month macro route.
Yeah, he does.
If it clears that 53-cent hurdle, he sees hitting $1, then $1.63, and eventually a cycle target of $5.
Wow.
Which would be a roughly 1,400% gain from current prices.
But Patel stresses heavily that this entire bullish thesis is completely contingent on reclaiming those resistance levels first.
Absolutely. Until it breaks that roughly 54-cent mark, it is just sideways accumulation in a very hostile environment.
Yeah.
The tension between the incredible revenue-generating fundamentals of the protocol and the structural inflation of the token is exactly what keeps us trapped in this range.
So what does this all mean for you, the listener, as you look at your portfolio for September? It really comes down to answering that central question we posed at the very beginning of the deep dive.
Right. Are you investing in Ondo Finance, the protocol? Or are you investing in Ondo, the token?
Because right now, they remain two completely different bets. The protocol is an institutional juggernaut. It is quietly and profitably taking over the real-world asset space.
While the token, however, is a highly inflationary governance experiment, just waiting for legal permission to actually participate in that financial win.
But if that fee switch vote passes and the Clarity Act provides the legal cover, those two separate bets finally merge into one cash-flowing asset.
Exactly. You just have to decide if you have the stomach to hold the token through the Delaware lawsuits and the monthly unlocks before they finally open the vault.
And before we wrap, there is one final, almost sci-fi piece of the Ondo puzzle that our sources highlighted.
Oh yeah, this points to where this entire industry is headed long-term.
It's wild. Ondo is currently shifting their infrastructure away from a standard public blockchain model to something they call the Ondo Network.
Yes, they are moving to a privacy-first execution environment, using what are called hardware enclaves, or TEEs.
Trusted execution environment.
Exactly. For those unfamiliar with the physical mechanics of this, a TEE is essentially a secure, isolated area inside a computer chip.
Right.
It executes code and processes data in a way that not even the owner of the physical machine can look inside and see what's happening. It separates the execution of the trade from the public consensus of the blockchain.
Meaning Wall Street firms can trade these tokenized assets at incredibly high speeds, in total privacy, kind of like a traditional dark pool.
Yes, exactly like a dark pool.
While still using cryptographic proofs to settle the final transaction on public chain, it solves the biggest institutional complaint about crypto, which is that all their trading data is public for competitors to front run.
Which brings up a really profound thought for you to mull over. If this privacy-first hardware enclave system works, what happens to the tokenized asset market when autonomous AI agents start trading these real-world assets?
Think about it. AI agents don't need pretty user interfaces. They don't need web browsers.
No, they don't.
They just need high-speed execution environments and verifiable cryptographic proofs, which is exactly what the Ondo Network is building.
It completely changes the landscape. You could have a future where AI agents are algorithmically trading tokenized U.S. Treasury yields across global markets at the speed of light.
Entirely within these secure hardware enclaves.
Yes. Completely invisible to the public eye until the final settlement.
It is a whole new frontier for decentralized finance. Just imagine our vault from the beginning of the deep dive. In a few years, it might not be Wall Street suits collecting those $66 million in fees.
No.
It might be populated entirely by autonomous AI agents executing trades on tokenized treasury bills in total darkness while we are just left standing outside holding a governance token, hoping they finally flip the switch and let us share in the wealth.
It is a brilliant, terrifying, and just profoundly exciting shift in how we think about financial infrastructure.
It really is. Well, thank you for joining us as we unpack this massively complex ecosystem. Keep an eye on that Clarity Act, watch how the Delaware Chancery Court handles the leadership dispute, and obviously keep a close eye on that 54-cent resistance level on the charts. We will see you on the next deep dive.